Microsoft, stock ticker MSFT, is currently trading at $338.37 per share, and year to date it is up over 41%. Now, over the past 5 days, it's actually down about 1.69%, and you can see a little bit of a sell-off right around here, and that was due to the latest quarter's earnings report, which we need to jump into in this video. So let's go ahead and dig into it. We can see Microsoft actually had beats on their top and bottom line. Earnings per share came in at $2.69, which actually beat by about 14 cents. And they had revenue of $56.2 billion, which is up over 8.3% year over year, which was a beat by $710 million. Yet despite this, we saw shares sell off at around 2.4%. Now, beating earnings expectations is nothing new for Microsoft. They've actually done it 3 out of the last 4 quarters, as we can see right here, and we can see their earnings growing quarter after quarter. So the question is, why did we see a slight sell-off in their shares? Now, revenue in productivity and business processes was $18.3 billion and increased 10%. Revenue in intelligent cloud was $24 billion and increased 15%. Revenue in more personal computing was $13.9 billion and decreased around 4%. And obviously, I don't like to see decreases in revenue in any segment of the business, but really, again, that doesn't justify the sell-off. So what was the reason for the sell-off? And most analysts are claiming that shares sold off after the earnings report as analysts process a delayed AI ramp. A little more specifically, Microsoft talked about how they probably won't see considerable growth in artificial intelligence revenue this year. The growth should start to show up in the first half of next year, according to Microsoft's finance chief. Microsoft is a leader in AI, and over the past few months, they have made quite a few exciting announcements, but none more exciting than when they announced Copilot, the AI-powered future of Office documents. According to Microsoft, Copilot is a modern AI assistant that will help Microsoft 365 users create Office documents. So whether you're working in Word or trying to put a PowerPoint slide together or even analyze data in Excel, this AI tool will be able to do all of those things for you. And I think it's safe to say that this will eventually become a tool that is used by businesses every single day. And Microsoft has already announced that they will charge you $30 per month to use the AI tools with Office. And that's on top of what you already pay. So this has the potential to be a really phenomenal new revenue stream for the business. So in my opinion, the fact there was a slight sell-off due to the fact that growth with AI should start to show up in the first half of next year is a little bit silly in my opinion. We're talking about a business that has an extremely wide moat, is one of the leaders in AI, and has the potential for some phenomenal new revenue streams through AI. Not to mention that Microsoft is also a leader in the global cloud market. Now, this data is as of Q1 in 2023, but we could see they had 23% of the market share, and I think that does have the potential to grow in the coming years. So I think the future growth prospects for Microsoft still look pretty strong. Let's go ahead and look at some of that historical data. Now, obviously, I'm a dividend investor, so I do want to jump into the dividend metrics. Let's go ahead and click on it right here, and let's look at that dividend history, and it's pretty clear right away. This company has a phenomenal history of increasing its dividend payouts year over year. They've increased dividends for 18 consecutive years. If we look in 2013, they were paying out around 23 cents per share every single quarter, and jump forward to now, it's now sitting at 68 cents per share a quarter. Jump over to that dividend growth tab, I'll scroll down, and you can see the company has a 10-year compounded annual dividend growth rate of over 11.57%. So yes, obviously really strong dividend growth over the past decade. And so when you look at a company like Microsoft and you look at the dividend yield, you're thinking, oh, the 4-year average dividend yield, only 0.96%, nothing too crazy. And the forward-looking dividend yield right now sitting below 1%, only at 0.8%. So obviously not a very high starting dividend yield, but when you have companies like Microsoft that have explosive dividend growth, you really want to be looking at that dividend yield on cost metric. So we'll go ahead and scroll down and look at this chart. And you can see over the past 10 years how your yield on cost would really skyrocket. If you would have invested in this company around 10 years ago, your yield on cost is going to be sitting at around 8.5 to 8.8%. So not only are you getting phenomenal share price appreciation, but you're getting really high dividend payouts over a long period of time that definitely beats inflation. Now, anytime you have a high starting dividend yield or just high yields on cost, one thing I do like to look at, and you should be looking at it anyway, is the dividend safety of your investment. So we need to look at some of these payout ratios. The first thing I will point out is the dividend payout ratio for the trailing 12 months, sitting at a very healthy 27.45%. But I also like to look at the cash flow payout ratios. Dividends are paid out of free cash flow. So when we look at the trailing 12 months cash flow payout ratio, it's sitting at 22.69%, pretty healthy. And then the cash flow payout ratio forward looking, actually under 20% at 19.87%. Now, for a company like Microsoft, having a cash flow payout ratio at around 20% is exactly what you want to see. It leaves plenty of room for them to continue to increase the amount they pay out in dividends, either buy back shares or seek out mergers and acquisitions, and obviously just reinvest back into the business for organic growth, which it looks like they've been doing a lot of lately. And speaking of buying back shares, while we have seen phenomenal dividend growth from the company, they have also been buying back shares at a very rapid rate. They have bought back over 11% of its shares outstanding since June 13, which is a great way to provide value to shareholders. So in my opinion, the historical data and forward-looking outlook for Microsoft does look very good, but is the company trading at a good value? So to answer that question, we do need to jump into my stock valuation spreadsheet and look at a few different valuation models to determine its intrinsic value. And like always, if you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But let's go ahead and come up here and plug in the stock ticker MSFT and hit enter, and you can see all of this data will automatically load in. And obviously you can see where there was a huge dip during 2022. We're looking at a 1,000-day change chart, but obviously we've seen a huge run up over the past year to date. Now, like we've already talked about, dividend payout of $2.72 leads to a dividend yield of 0.8% and a payout ratio sitting at around 27.4%. Analysts currently have a target price of $384 per share and a beta of 0.91, so you actually see a little bit less volatility than that of the market with Microsoft. Now, the first valuation we're actually going to look at is going to be Graham's valuation. You can see the formula he lays out for us to calculate intrinsic value right here. Now, I think there are some stronger valuations than Graham's valuation in the case of Microsoft, but I do still think it has some value. So what we're going to do is we're going to plug in our forward-looking earnings per share expectations right here, and then multiply it by our growth rate projections, and I am staying in line with analyst expectations, so we do have a pretty high growth rate projection. We then multiply that by the average yield of AAA corporate bonds at 4.4, and divide by Y, which is the current yield on AAA corporate bonds, and that gives us an intrinsic value of $258.84, decent bit below that current trading price. But let's go ahead and keep looking at these other valuations. The next one we'll look at is the discounted cash flow analysis. What we need to do is project a growth rate to the future free cash flows for the company so we can see how much future free cash flow it will produce over the lifespan of the business. So I looked at the historical free cash flow over the past 2 years, and we've seen some pretty good free cash flow growth rates. Again, moving forward, I'm going with a pretty high free cash flow growth rate of 15.5%. I'm projecting that to the future free cash flows of the business and to the terminal value, which is the sum of the future free cash flows past the year 2031. I then added all of those future free cash flows together after finding their present value, added the cash and cash equivalents, and subtracted out the total debt to get their equity value. Once I had that number, I divided by shares outstanding and came to a discounted cash flow price per share of $325.67, quite a bit closer to that current trading price. Now, typically the next valuation I look at is the multiples valuation, but I think Microsoft is so unique in its business structure, they don't have a lot of great multiples or comparables, so I actually didn't use it in this scenario. But the last valuation we'll be looking at is the dividend discount model. Now, I love this valuation model because it values a company based on how much they pay out in dividends and how much that dividend is increasing over time. So what I've done is I plugged in the quarterly dividend payouts over the past few years so we can see our yearly dividend payouts and the year-over-year dividend growth rates. And you can see it's been sitting pretty close to 10% each year for the past few years. We have 10.87, 9.8, 10.71, and 9.68. So that's an average growth rate sitting at 10.27%. And like we saw earlier, they had around an 11% dividend growth rate over the past decade. So moving forward, I'm projecting a dividend growth rate of 8.25%, discount rate of 9%, and that gives us a dividend discount model price per share of $392.59. So when we jump over to our output tab, we can see the three valuations that we use. We have Graham's at $258, DCF at $325, and dividend discount model sitting at $392.59. When we average those three together, we come to an intrinsic value of around $325.70, which is only a difference of about 3.89% between its current trading price. So while the intrinsic value is slightly below that current trading price, you do need to understand Microsoft is one of the best businesses in the world. They have a market cap of over $2.5 trillion, and they have some phenomenal competitive advantages. In my opinion, that's going to always lead to this company trading at a premium, so it's no surprise to me the current trading price is slightly above that intrinsic value. When you think of a company like Microsoft, there's no doubt a decade from now, all of the underlying metrics are going to be better than they are right now. You know, those dividend payouts are going to be higher. You know, the earnings, the free cash flow, all of those things are going to be much higher for Microsoft, so people can feel confident in paying a premium for this company. Short term, I obviously don't know what the price will do, but long term, I think if you buy at this price, you should still be doing pretty well. Me personally, I actually don't plan on adding shares, but that's because this company is already a very large position in my portfolio. It's around 11.7%. That's my largest largest position behind a dividend ETF, and I've also seen some really nice gains from this company. I'm currently up around 27% on my Microsoft position. So while I don't plan on adding more shares at this very moment, I do continue to plan on reinvesting dividends back onto the business and letting the compounding effect take place with my Microsoft stock. So there you go, there's a quick analysis on Microsoft. Go ahead and let me know if you own this company, you plan on buying in the comments down below. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.